webinar. Today we are presenting our Q4 outlook on oil. So we have roughly an hour in total to convince you of our views on the market for this winter. My name is Neil Crosby, Head of Analytics, and today I'll be your host and also one of our speakers. Joining me for this session are three of my expert colleagues. I have Phil Jones-Lux, Senior Oil Market Analyst. Please say hello, Phil.
Good afternoon, everybody, or good morning where you are.
We also have Jorge Molinero, our product expert for light ends. And we have James Noel-Beswick, product expert for middle distillates. Say hi, guys.
Hello, everyone. Thank you for joining us today.
Now, a quick word for those less familiar with Sparta. Sparta delivers real-time, forward-looking market intelligence built by traders for traders. Where traditional tools show you what happened already, Sparta helps you spot what's changing and allows you to act fast, whether it's a shifting arb, a freight dislocation, or a blending mispricing. We focus on actionable insight, not noise or lagging indicators, so you can close the gap between price and value and trade with real conviction. And before we dive into today's session, I think this short video says it better than I ever could. It shows what we're building and why it's not just another dashboard. So bear with me one very short second.
You're chasing the market. Noise hits you from every side. You're drowning in spreadsheets. Brokers and colleagues are on you to make the call. You face conflicting prices. Your team's not aligned. And while you rerun numbers and call your brokers again, the market slips away from you. Welcome to Sparta. Sparta gives your team one shared, real-time view of the full market. It shows you the gap between price, futures, swaps, physical, freight, and value, live arbs, blending, refining margins, all in one aligned source of truth. Your whole team makes decisions based on the same prices, the same curves at the same time. Live tailored news and market insights surface the moment they matter. Run your own assumptions, customize values, and share views instantly. Shape charts and dashboards around your exposures, region, and strategy. With Sparta, you get clarity, control, and collaboration, all in one simple interface. Ready to trade with more conviction?
So that's the vision behind Sparta, a simple, smarter way for trading desks to align, act faster, and make better calls with confidence. We already have solutions for gasoline, naphtha, middle distillates, crude, freight, and fuel oil. So we cover most of the oil barrel, providing our clients with a comprehensive cross-desk solution. Now, with all that said, let's get the content flowing. And this time round, I will actually kick us off on the general state of the market and also give us a few hints as to what my colleagues will go on to talk about. Now, a general theme that we need to touch on today is, of course, the oil glut, which has been highly telegraphed for quite some time now. So what's the status here? Well, we know that flat price and time spreads are well down this month. That's pretty evident to everybody, I'm sure, on this call. But I would argue this is not yet the definitive realization of the oil glut story. So some of the price action this month has been related to wider developments in markets with lots of macro risk around, and of course, a lot of headline-driven stuff in geopolitics, something which this morning's rebound in flat price and spreads tends to underline. And of course, there are headlines flying all over the place regarding US trade deals with India and potential reduction in Russian buying and the developments in the Ukraine peace talks. I would say, in terms of real evidence of the glut itself, we're at an early juncture, really. So we have some high-frequency data telling us there is a problem developing. So we're talking about high global crude exports and a lot of oil on water, some of which is subject to revisions. On the other hand, onshore OECD inventory, which is what really influences time spreads longer term, hasn't risen that much yet. And I argue until those data points start to rise rapidly, the market can't really price the arrival of the glut to 100% certainty. And then, of course, there's still lots of headline risk around to be wary of, as we said. So the first of only a couple of EIA charts we want to show you today, just to underline this point, is total commercial oil inventory in the US at the bottom right there. And we are in a way still scraping along the bottom at low levels. So what does make sense to me now is that the Western Hemisphere has a higher chance to see the glut showing up this quarter, provided that supply figures are sustained. One big change that will drive this trend is the relative closure of crude arbs to the east. These arbs were very open in Q3 due to the extreme strength in Dubai, and I argue this actually prevented Brent and TI from getting too weak last quarter. Today, though, the picture is that over much of October, the arbs are far less clear, much less workable, because Dubai has eased with more sour crude supply coming to the market. So that relief valve has been removed, and that's also being felt this month on the Brent market itself. And just to illustrate that, the top right chart there shows essentially our WTI arb to the east. Over August and September, it looked really open in the green box. More recently, it's actually basically closed off or returned to average levels, let's say. Now, the last slide I have before I want to pass the baton on is on east versus west pricing. That's something that will come up again and again in this presentation. And there we've seen some remarkable shifts. So Brent Dubai had rallied over September and early October. It looks a little different right as we speak this week. That's the thing with fixed webinars. The market can always tell you something slightly different on the day. But in fairness, it's also in a big way headline driven right now, as seems to be the case through much of this year. But in general, on average, the Dubai market had weakened on higher sour supply, and certainly the AG spot premiums weakened as well. In products, the East-West reflects slightly different things. So naphtha East-West is at record highs. That's what you see in the top right chart there. Mostly that is over fears of low Russian supply, but also, in fairness, plentiful supply in Europe. The bottom right chart is diesel East-West, which is unusually tight or narrow, meaning Asia is priced up and the key short Europe is priced down. And this in a way reflects at least a temporary glut, we think, in the prompt in Europe. And James can elaborate there for us later, I'm sure. And lastly, in fuel oil, the East-West is also very unusual just now. So Singapore is quite weak. It seems to have too much supply, whilst Europe is tighter. And at least in Singapore, that matches to a degree the rise in sour crude supply that we've been seeing over Q3. So all in all, on average, we have crude structure and East-West telling us something new in most cases. Much of it revolves around a relative glut in the key short markets, with naphtha being a bit of an outlier. Now, with that said, I hope you have a good basis on which my colleagues can dive a bit deeper into their respective markets, and I'll hand you over into the capable hands of Jorge.
Hello, everyone, and welcome to this webinar. Thank you, Neil, for the introduction. I'm Jorge, and I'm going to talk about the light-end side right now. So I have to split this presentation into two parts. First one, I'm going to focus on the gasoline markets. Then I'm going to move on into naphtha, LPG, and some bits on the petrochemical side. So starting with gasoline, I want to focus first on the European market, since it has outperformed Houston and Singapore for the last weeks and months, and we are in a very tight moment currently. So I have two charts, both reflecting epoch crack. In the first one, we can see the last uptrend we've seen, and in the seasonal one, we can check that it's trading at historical seasonal highs for the last 10 years. So right now, European market is really tight, and this trend is also pushing lower TAR and East-West spreads. But what are the bullish factors behind this? I have selected three different ones. First one, Europe has felt a lot of unexpected outages since the second half of August, and this has tightened the supply side and the whole balance for the European picture. And then we have also the news from West Africa. So the market is pricing in a higher export into West Africa during this Q4, We are already seeing them. And at the same time, a tighter supply in the European market. And this has taken EPOC crack to the levels that we are seeing currently. Then we have two more factors. First of all, on the component side, we have seen less components availability in the region recently, less imports, and it has allowed the E10 and E5 margins to remain open for a while without being really bearish for the EPOC complex. So usually this what it margins points is the margin of buying the components locally, blend them, and selling in the window. What should be bearish for the European complex, but with all the supply issues and the exports to West Africa, we've seen the market to remain tight despite E5 and especially the margins remaining open. And the last bullish point is on the arbitrage side. This is changing right now, but we have seen European really competitive into the Atlantic Basin, European exports. So despite a very tight market and exports to West Africa rising, there were some options into Latin American outlets, also for Europe, mainly because of the spread between TC4, TC14 and TC2 widening during the last weeks. And with this, I'm going to jump into the arc picture to see a global perspective. First of all, here you have the chart about TC14 and TC2. Here you can see how the spread has widening, allowing Europe to remain competitive into Latin America despite the strength in the European market. Right now, the picture is has improved for US Gulf Coast export. So ARA just remain competitive marginally into Brazil and of course into West Africa. And into the East, we have a very interesting point. Europe, of course, is not competitive into Eastern markets, mainly into East Africa, which sometimes is the switching barrel. Right now it's not, with a low level of East-West. And Singapore, usually in our arbitrage calculator, is the cheapest source of supply for US West Coast and also for Mexico. Right now, the picture is not like that, and Singapore just remain priced into US West Coast, not into Mexico. This also gives us a better outlook for US Gulf Coast exports in the short term, not just competitive against ARA, but also against the Eastern exporters. And the last part I want to highlight about gasoline is the TAR. So moving outbound cargoes from ARA into Path 1, we have seen low levels of this arbitrage during summer, which is the seasonal peak. And the main reasons behind this, first, we can find it on the paper. TAR net RPO has reached historical lows for Q4. Here you have it on the chart. So at this level, it makes the arbitrage mainly unworkable. And then on the supply side in the US Gulf Coast, we have strong stock levels in Path 1 and in Path 3, and also crude runs, healthy crude runs, and in the US Gulf Coast. So the region points to be well supplied in the near term, and we don't expect this flow to increase in the coming months. And the last point is that we've seen the first Dangote LR exports of gasoline during second half of August and during September into Path 1. Right now, we don't expect to see that until the year ends, but it could change the picture for this arbitrage from Q1 next year onwards. And with this, I'm going to move into NAFTA. We've seen the market structure trading in contango for the rest of Q4. We saw a very big uptick yesterday. Right now, the market is close to flat, but with backwardation. But I think the threat of contango remains for the rest of the year. And let's go through the main reasons behind this. So we have a very strong fundamental on the petrochemical side. If we check ethylene and propylene prices, they have dropped globally, but the main drop has been for ethylene in Europe. Since the second half of August, we have seen a drop more than 20%. And of course, this is impacting the physical premiums for naphtha in Northwest Europe. We have seen discount for a while, and this is one of the reasons behind the various trend in the European market. Then we have propane being more and more competitive as a steam cracker feedstock, especially in the east, but also in the west. So it's also harming the economics of naphtha in the ethylene plants. And the main supportive factor we've seen since summer has been the arbitrage into the east. It has been wide open with the strong cash dips in the east. Right now, the arb remains open, but our expectation is that it won't be as supportive as it has been during the last month. And I will explain that in the last slide. But first, I want to talk about the run-up in the east. We said that is a very big bearish factor for naphtha, not just for the monthly complex, but also for the European ones, And currently, it's trading at 10 years historical lows for Q4. What are the reasons behind this? We have a supply from US Gulf Coast that keep rising and rising, and the expectation for 2026 with new additions is for that to keep being bearish for this spread and for the Far East index propping. And not just that the flow is increasing, but a big percentage of it is going to fade linked outlets like Japan, Korea, Indonesia, or Malaysia. China, has seen a lower market share and it's replacing this volume with product from the EG. But what is relevant for the Far East index is that the supply is increasing and it's being bearish for the flat price and also for the spread with naphtha. Then we have also the big drop that we saw in Saudi LPG, mainly in propane, that is also adding pressure to propane naphtha in the east. And the conclusion for this is that it will keep harming naphtha competitiveness in the steam cracker pool, and it's overall bearish in the medium term for the naphtha markets. And the last part I want to show you before we move on into distillates is the East West. So East West right now for naphtha is traded at historical highs for the last 10 years, not just for Q4, but also for the whole forward curve in 2026. So what's the driver behind such a tight East-West? First, we have lower Russian exports. We've seen several attacks into Russian facilities that has decreased this flow going to the east. And then we have had a strong turnaround season in Middle East. And with these two factors, Asian players had to find the product in the West, not just in Europe, but also in US Gulf Coast. And they have kept rising the gas dips for months, and also the East West has reflected in the current levels. Our expectation in the short term is for it to ease. Maybe it will keep tight for the rest of the year because the attacks on Russia will persist. But for Q1 next year, we will expect to see lower volumes. We are approaching steam cracker turnaround season, so less cargo will be needed from the east. And that links to the first slide where I said that even if the arb remains open, it won't be as supportive for the overall naphtha complex as it has been during the recent weeks and months. And now I'm going to pass the floor to James, who is going to talk about the distillate markets.
Good afternoon. Thanks, Jorge. Yeah, well, so the general view that I want to express today is that I'm generally bullish ice gas oil and deck from here. Let's talk about some of the context to how we got here. We saw that refining margins globally were very strong over the summer, and that's resulted, or that had resulted in a lot of ARBs into Europe for September and early October arrival. I'm going to talk about some of the further context behind that as we move on to the next slides. But actually, when we look at kind of November arrivals now, almost all of the major diesel ARBs globally are closed into Europe. And that's the main thing that's driving me to have a bullish view on ice gas oil, as I spoke before. On top of that as well, we've also got the Russian molecule ban ahead, and that's going to combine with the already situation that we've had, continually declining Russian diesel exports are very important to monitor as well. So the HOGO has been generally widening probably since the start of or end of September or start of October. And some of the reasons behind that are pretty clear. So we've had reducing US crude runs, as you can see on the top right-hand chart. And that's reflective of the fact that we're moving further into autumn maintenance, or into the US autumn maintenance period as well. On top of that, the recovery in US diesel demand has been a pretty important factor as well. And perhaps a bit of a caveat to that view about the HOGO finding a ceiling is that US temperatures will be important to monitor. I think we're heading into a La Nina winter where we should expect generally colder temperatures as we move into winter. But I think now, and something that's really important about that view about being long NOVDEC ice gas oil is that with a closed US Gulf TA ARB into Europe, essentially diesel ARB, I think there's quite a strong argument to be short the HOGO, essentially for the HOGO to find a ceiling. So we've seen November gas oil, as Neil was kind of speak about in the introduction, has narrowed by something like $12 per metric ton since the start of October. And some of the key drivers for this has been also that glut we just described, or increased arrivals into Europe, which has weakened the western side of that equation essentially. But also we've had reduced South Korean in particular, but also Chinese diesel exports due to like low refined product quota exports, which have been driven mostly by regional turnarounds. So that's kind of strengthened the eastern side of that equation. That's resulted in the fact that Middle Eastern ARBs, so the AG, West Coast India ARBs, now point definitively east and have done since the end of September, essentially. And now kind of the margin between East Singapore, essentially, and Europe West is the biggest it's been since probably July. And I guess I now think that the East-West has done enough and we should start to see it widen once again, which, to be fair, is something that we've seen it already do partially since the start of this week. I think an important caveat is that Chinese distillate exports are expected to continue to be low because of those previously mentioned low Chinese product export quotas. And before I hand over to Neil to talk about crude, also an important piece to discuss is jet as well. So we've seen that the switch to winter diesel has helped diesel, but also it's also helped jet. We've seen an increased amount of jet blended into the diesel fuel pool. The taken out of El Segundo, or the outages at El Segundo refinery has also been a boon for Asian jet as well. I think El Segundo provides something like 40% of the jet to Southern California and therefore Los Angeles, which is what I think the 10th biggest airport in the world. So we've seen as a result of that, or a partial result of that, Singapore regrade moved to its highest level essentially in at least the last 8 years. And then that's had the effect that that's closed all Asian origin jet ARBs, apart from Red Sea, because they're geographically close, into Europe. And this, so closed ARBs into Europe for jet, allied with increased jet blending into the diesel fuel pool to meet cold properties, is a reason that I'm also bullish jet as we move further into Q4. That's me for now. I'm going to hand over to my colleague, Neil.
Trouble with microphone. There we go. Yeah, thanks very much, James. So I'll take us forward with just 3 more slides on the crude market. The first revolves around the emerging battle for short-term market share in Asia. I talked earlier about the weakening in Dubai after the summer, as more sour supply has come to the market. The problem there is, of course, that WTI and other crudes that benefited from the open ARB during the summer, such as WAF, now have to compete again for Asian buying against a weaker Dubai market. So in order to do that, especially to get over the by now much higher freight rates to go long haul, West of Suez crude actually needs to price down. And we definitely already saw the result of that in WAF premiums this month, which fell off a cliff essentially. And this has this has hit the North Sea market too over the last 10 days or so. So the top chart there shows the WTI versus Murban ARB into the Asia. WTI was very open and this is now normalized, so no more easy ARB. The bottom chart there again shows our basket valuation for Qua in Europe. It has, as a consequence of having to compete in Asia, started to look very cheap there. That is normal. And as a result, North Sea structure, as we know, probably, and FOB premiums have started to weaken quite a bit too. Now, this is really a general theme. The long West of Suez crude market needs to price down and compete. So the first thing we expect on a general basis is for Brent to stay relatively priced down versus Dubai this quarter. But I also want to caveat this. It's one thing to give a general outlook over the span of several months. The other thing is to look to today and what prices say and what headlines are doing. And there we have some nuance developing, let's say. So as a result of West of Suez spot premiums having weakened so much, actually a few of our West of Suez crudes are starting to just creak open again to the east in terms of the ARB econs. That includes things like Nigerian Agbami, and it includes heavy stuff like Johan Sverdrup, which looks quite cheap now in Asia in the bottom right-hand chart here. So just on that basis, I've lost a little short-term conviction in terms of further Brent bearishness versus Dubai paper. I also think there needs to be a bit more pressure on some of the AG spot premiums in the next week or two, particularly looking at Murban probably, which now looks a little overvalued in Asia, which we can see in the top right chart there. And of course, the last caveat, as always, seemingly this year, is things like India, with the headlines over the last couple of days. So, a potential US-India trade deal and reduced Russian buying obviously would be very significant for Dubai in particular, and Dubai partly responded today on that basis. But I think that's a trading as is basis, and we're still lacking a lot of clarity there for sure. The last one from me is on WTI Brent spreads. So a common theme that we've been talking about for the last few weeks and months is WTI normally is the marginal crude in the world when things get long, and that means WTI needs to get cheap. TI Brent paper spreads are certainly already a lot wider than we saw over the summer, and that partly reflects the slightly different ARB situation, as well as admittedly higher AFRA rates out of the Gulf Coast to Europe, higher dirty freight rates in general, of course, but TT25 is very strong. So it's perhaps a little early to say that TI is acting more and more like the marginal barrel. Nonetheless, I think that's the direction we go in this quarter if the market stays relatively long, which means TI Brent can spend more time at wider levels on average. The last thing and the last problem there is Cushing, where stocks are still low and drawing. The new problem there is that TMX flow out of Vancouver is going very strong indeed, and partly preventing Cushing from rebuilding. The short-term solution there is for MEH to weaken, as we have already partly observed this month, to help rebalance Cushing and also to help WTI compete in Northwest Europe. We're just looking at our signals dashboard this morning, and WTI is starting to look slightly more expensive, and MEH can try and solve that. And then on a general level, I would say even if we get big stock builds in pad 3 to a much greater degree than in Cushing, it's still a bearish signal overall, particularly knowing that there are some special circumstances in Cushing just now relative to other years. So it doesn't necessarily mean that TI Brent paper cannot widen. So that's a whirlwind tour. I will pass us on to Phil now, who's going to finish us off on our fuel oil segment.
Just 2 slides from me today on fuel oil. One low sulfur, one high sulfur. On the low sulfur side, it's been a story of strong supply over the last few weeks. What we see on the chart here is a lot of lines, but the line that's going up is the blend cost. So that's the differential between the component prices and the finished grade swap. So we can see that relatively speaking, it's been getting more expensive or more difficult to blend finished grade VLSFO on the basis of the components that are available. But that hasn't been because of not enough supply. It's the opposite. The supply is fantastic, but the lines that are going down we see are the cargo cash premium. So actually the differential between what people are willing to pay versus the swap, and therefore the blend margin. That blend margin was positive. That typically leads into a move down on time spreads, and we've seen that as well. So that NOV-DEC time spread, which is in contango, that contango has been steepening. Question now is, why did it come and will it stick? So demand through the turnaround period hasn't been fantastic. As we know, there's been a lot of secondary units offline, which is also why supply has been quite strong. Supply has also been strong, though, because it seems as though at least we've had a lot of sweet crudes being processed overall. Looking forward, though, will it stick? So we will see demand picking up again for those low sulfur molecules as we move into as we move further into the quarter and refineries and the secondary units return. And we have closed blend margins now, as we can see. So those closed blend margins, the return of the secondary units, bringing back demand, taking some of the supply out of the market, and the strength in the high sulfur market should help to now find a floor on VLSFO, and if anything, be a bit of a supportive factor going forwards. On the high sulfur side, we've seen effectively the opposite situation. So it's been very strong over the last few weeks. What's been happening? That strength has been mostly coming from the west. So we've got a negative east-west at the moment. That's what we can see in the upper chart. That upper chart is a rolling front month of the 380 east-west in this case. And we can see that whilst it does historically turn negative, it doesn't typically last for very long. So what that's been driving or allowing to happen is that we have very open arbs for high sulfur AG feedstocks coming from places like Iraq, but other places in the AG into Europe and into the US. So the other chart that we see on this slide is the US other oils imports, which we see actually for the majority of this year have been very low. But we saw within our tool and within the arbs that we run that the arb for those feedstocks out of the AG into the US opened quite strongly from July onwards. And we can see from mid-August onwards, those levels of arrivals really ramping up. And that's been helping on the flip side to support also refinery margins in the US in general. But just to take a quick step back, how did we get here? Or just a recap, how did we get here for this high sulfur strength? It's the light sweet slates that we talked about before, which have been dampening the low sulfur market. And it's also that the very strong products markets, the very, very strong products markets that we had in 2022 and 2023 helped to support that low sulfur resid demand more. And product cracks haven't been bad by any stretch of the imagination, but that particular support for the low sulfur versus the high sulfur isn't quite as strong, and that's allowed that high five spread to narrow. That high five spread narrowing now is part of the solver, though. So for a Q4 outlook, we have higher runs coming back with turnarounds ending, so we should see more also high sulfur resid availability in the market. Importantly, though, our fuel oil blender really points to that all of those mid-sulfur barrels that can either go into low sulfur or high sulfur blending are being redirected very strongly into the high sulfur market at the moment. And that is going to be a solver over the next couple of weeks to increase that finished high sulfur fuel oil market. The blend margins for high sulfur fuel oil are just about workable at these levels. And a more medium-term outlook is that we are seeing more sour crude coming back into the market. Neil mentioned that at the very top of the piece. So incrementally, there is more sour crude coming back into the market, especially in the east. The question is, how do you get those molecules back into the west? So it may be that actually our forward east-west can remain at least relatively depressed. On that, having just mentioned Neil, I'll bring him back onto the stage as well as everybody else, if that's all right. And we can move on.
Yeah, thanks very much, Phil. Let's get everyone back on stage. It's time for a bit of Q&A. I think we have a fair chunk of time to answer a couple of questions. We won't get through perhaps absolutely everything, but let me just grab a few here. James, I've got the first one for you, if you don't mind.
Yeah, no problem.
How do we interpret the ongoing backwardation and strength in diesel cracks with the lack of strength in crude? Will diesel move into contango?
Thanks. Yeah, I think there's a similar question about what the downside risks were to my bullish NOV deck ice gas oil call. So let's try and link those two together. So we've got now the basis behind that bullish diesel call is low exports resulting in low arrivals into Europe, essentially. And that's been driven mostly by the period of maintenance that we're going through in the US, AG, and Northwest Europe now currently. But this weakness in crude is contributing, I think, and I'd like to hear what Neil says about this, also in very strong refining margins currently. So I wanted to be very exact that it's a bullish call on NOV deck. When we come out of turnarounds now, global maintenance, with refining margins this strong, those exports should ramp up relatively quickly. These refineries should be running very hard. So I think it's quite maybe like a short to medium term call on like a bullishness. Although saying that things are going to turn again bearish, we've also got the kind of typical demand peak that we get for distillates as we move into January, February in Q1. So how long that bearish stance will last for is up for discussion. Hope that answered it.
Yeah, I would just add, James, that we've talked a lot on our podcast over the last few months about basically where the bottleneck is. So how can we explain that margins can just be sustained at this level, strong level? And one of the things we've said is there's just not enough capacity around, particularly if China is not willing to, let's say, flood the international market with product exports. And you can see it in some of the data, the effect of margins, right? So US runs have been very high up until last week, but it's partly replacing things, right? So if Russian diesel exports are extremely low because refineries are being attacked, if Dangote has got a very checkered operational history, let's say, and you've got 500 kbd of European refining capacity that's gone offline this year, you have the US trying to make up for things elsewhere, and it's not necessarily flooding the product market yet. Let me grab a different one. Let's do it related. What are our views on EU's Russian molecule ban in January? Who wants to go? Shall I start?
Yes, please.
Well, yeah, we were just looking at the paperwork, basically. So it took a long time for the EU to bring out the regulations, if you like, or the advisory. And it looks like things will be fairly arduous, fairly stringent in terms of the origin of the product. Clearly, it's down to Indian refiners' choice. It might result in Indians reducing imports and runs of Russian crude. So that obviously that's a related topic to the crude market. Similar situation to Turkey. And I would imagine that ice gas oil pricing starts to price up in advance of this thing, because that's typically the pattern. But the question, as always, becomes, there's always the freight rerouting, there's always the rerouting of product around the world, which simply takes time. And we don't know yet about re-exports that much. We don't know about these exemptions for the net crude exporting countries. It's all very expensive in terms of freight, but in terms of the actual reduction in volume coming into Europe, maybe short term it's high, but long term it may be relatively low. Do you guys agree with that roughly?
Yeah, I think that's fair. When you get these kinds of disruptions, whatever it is, you typically need some kind of short-term price solver, and the market typically has been very good over the last few years at finding ways to solve those questions.
Okay, yeah, agreed. Let's do one more question. You say the main driver behind the dramatic narrowing of the naphtha east-west since early September is on low Russian supply and Asian demand. both of these things could continue or even intensify into Q4. Is that correct? Is that how you see it, Jorge?
Well, yeah, I think the main indicator right now in the NAFTA market is East-West. So we've seen very strong levels, as I have shown in one slide. It's trading at historical highs, not just for Q4, for the whole curve 2026. And yeah, very quickly, like the main reasons has been lower exports from AG and lower Russian product. For me, I think the ceiling could be soon. I think it's going to remain very tight for the rest of the year, but I think it will probably ease during Q1 next year, because the import needs for Asian outlets right now are lower than for September or October deliveries, where we saw a lot of cargoes coming from Europe. Right now, the needs are lower, and yeah, it will depend also on the ability of Russia to recover the previous volumes. But overall, I think in the medium term, it won't keep reaching historical highs for Q1.
Good stuff. Thank you, Jorge. And a related one for you guys, Phil and Jorge. Do you think current EBOB levels are sustainable in the medium term, or correction is near? I guess that's spreads and cracks.
Yeah. So if you want, I can start, Phil.
Yeah.
From what we have presented, there is like a mixed feeling. First of all, there are a lot of questions about Dangote. Is the biggest driver behind the current strength. I think that in crack, what crude will do is going to play a huge role as well. But what it's more same time is the current exports outlook. So Europe has been very competitive into the Atlantic Basin, despite the strength in the European market, and for some moment it was competitive not long ago, also in the Eastern outlets. So that competitiveness means strength for the European complex. That is now gone. Right now, as we have said, in the East, this no longer competitive into any outlet. In the West, just marginal in Brazil and West Africa. So I think this could help to find a ceiling in the medium term.
Yeah, I agree. I think short term we've slightly run out of those bullish factors that have been keeping it at those kind of historical highs that we've seen recently. That being said, they never seem to be too far away, right? We will probably get news within the next couple of weeks if recent performance is anything to go by, of issues again at the Dangote RFCC. It's anyway returned not at full capacity, and by returning not at full capacity, it is likely keeping the need for European exports down into WAF. So as a baseline, demand in Europe is good. Our demand out of Europe, as you said, LATAM may be slightly drying up at the moment, but it's very dependent on freight, and that can move around. So we never see. I don't think we have kind of ongoing sources of support as well, even if right now maybe we're slightly above justifiable levels on cracks and spreads.
Yeah, we have another question here that's related with the on-off nature of the Dangote refinery FCC. How has that impacted European gasoline blending operations, ARA storage, keeping in mind Nigeria used to import 1 million tons per month, and much of that came from Europe? Yeah.
So it has clearly been one of the very supportive factors of the last few months. Whether or not that continues now, it's likely to continue, but in a potentially slightly reduced format over the rest of the quarter now. That being said, there's planned for a bigger turnaround as well of that unit in maybe late December, January time. So I think that this is going to continue to be a strong source of support. Very specifically, if we're looking at Refimet had quite a weak start to the year, but since we've started to have these issues in the summer, at the Dangote RTC, refinement premiums have strengthened, and I think that is specifically linked to the fact that we've had this uptick in flows into WAF.
Good stuff.
Yes, maybe one last point on that. I think is the main driver behind the strength on EBOB, because if you think about it, it was one of the main outlets for ARA, and in months we have started to see they exporting to another outlet for ARA, like Path 1. But what the market has priced in is a change in just a couple of weeks or months. So right now the market is pricing again ARA supply in West Africa, but the expectation, if you think about second half of August, was to see more LRs going from West Africa to Path 1. So that change, it's for me the biggest driver behind the strength in EBOB.
Good stuff, guys. I'm going to keep us going with another couple of questions to change tack a little bit. We'll go to more on the crude side. Here's one. Any comments on China absorbing a huge amount of supply this year? And as we get into the second half of 26, perhaps they're no longer a buyer at the same quantity. Where will spare capacity go? I guess my comments on this is that one of the things I found quite interesting this year was the fact that China did absorb some surplus this year so far. But as far as I remember, it's one of the only times where China absorbed a bunch of crude as normal, but absolutely none of it showed up, or none of that kind of surplus showed up in the OECD up until recently anyway. And I find that a very curious thing. In terms of what happens next, there's all kinds of different incentives that I think are very opaque. They have a price incentive. The classic way to answer this question would be, as soon as flat price gets low enough, China will step in and buy more crude, right? And I think that is one way to think about it. So that is a sort of standard part of the question. That is fine. But the next thing is just their geopolitical incentives as well, and it's tied up with the Russia story. So let's say we do get a headline, in the next couple of weeks that the US and India reach a trade deal. India reduces Russian imports by 50%. Let's say that's 800 kbd. What happens to China in that context? Do they see that as a geopolitical imperative that they support Russia in buying Russian oil? And then the next thing is, do they squeeze out a bit of spot purchases from, let's say, Brazil or the AG whilst they do that? Or do they build even more crude? And then the question becomes, how much capacity do they have to build at that rate? Let's say they started to build at 2 million barrels a day. I'm kind of skeptical they can do that, but it's one of the options. So my answer to that question is kind of simple. Like, I don't think we fully understand which priority comes first. But, they have SPR targets. They are buying Russian. They may well buy more Russian if they have to. The back half of 2026 becomes a slightly different story, perhaps. And, if they end up really dropping out of the market, we've seen that before in the past. That's bad for flat price, simply put. A sort of related question, which I will go to if I can find again. It's kind of like philosophical in a way, which I noticed, is, are OECD stocks still the best measure of inventory? It's a nasty one. I still think they are the best predictor for price in the kind of medium term. The problem with non-OECD inventory, let's say, is it's opaque. It's not well measured. Some of the non-OECD builds are essentially gone forever. So we're talking about Chinese SPR now. And the other thing here is completely non-traditional methods, things like oil on water. Obviously, that has been a big part of the story over the last couple of weeks. The thing is that measure also rises for a variety of reasons. That involves things like shipping sanctions. It involves crude moving on new routes. And it's not just more supply to the market. And the other thing I know from experience, having been involved in producing those types of numbers previously, is that revisions can be very large indeed, depending on when you get your data updates, when you get port reports. how you do a sort of nowcasting model, how that performs under certain conditions. So these things are very prone to revisions, which is completely fair enough. But what I think that's partly why Brent spreads are still backward at the moment at the very prompt, because the market needs a bit more certainty on what all these things mean. And imagine the other side of this argument. Let's say we saw continued rising oil and water, or very high levels, for another 3 months, but we saw no builds in the OECD, because I think the API numbers yesterday showed at least a flat crude number for stocks. I think we get the data in 40 minutes. Imagine that continues and you don't get any OECD stock builds again. Like, what does the market think about that? I think that would be a very confusing message. So I still think the OECD is the best indicator for the time being. Okay, that's another monologue over. Shall we? Maybe we have one more question, and guys, we can relate it to crude and diesel. Take us through what happens to pricing if India stops buying Russian, and it's obviously related to diesel as well, guys. I think the thing is that obviously it's quite bullish for spot AG crudes. It's generally bullish for the Dubai market. That's what prices are telling us at the moment as well, just on the headlines. We note that India is trying to, or let's say, they may look for crude of similar quality. So I note that there has been a few tenders for Guyanan crude into India recently. The question also just becomes, what is the response of China under this condition? Do they basically create a balancing act where the Chinese take some more Russian and they stop buying spot crude elsewhere, and it's a kind of net zero, let's say, reaction, although of course there's always price disruption whilst that kind of gets to a new equilibrium? Or is there no impact on Chinese spot buying, and in the end they just start to build more and more crude? I don't know what the answer is to those two things, but it's just one of these things that you need to trade as is. And of course the headlines seem to be flipping back and forth every single day, as has been the case all year long. One other option is that the Indian slate gets lighter overall, and I presume that means less diesel exports heading in either direction. Is that something that is on your radar as well, James?
Yeah, I'd completely agree. If India stops buying Russian crude, it's a very bullish sign for European diesel. I mean, one of the ways, I'm going to use the word workaround, that when Europe lost Russian diesel was to get this heavier crude slate via Indian refineries. That's why we've seen such a big increase in Indian exports to Europe over that period. I'm not sure where Europe then replaces that external diesel, to be honest. I'm not sure how much the US has got to give. Just very bullish, to be honest. Yeah.
Good stuff. All right, I think on that note, we have answered a fair amount of questions. So yeah, we're basically out of time. I'd like to thank you very much for listening today. Thank you for your engagement.
Thanks.
I hope you enjoyed our presentation and our questions at the end. A recording of this webinar will be available today or tomorrow, I believe. So please check your emails and our social media. And if you're new to Sparta and would like a demo of our platform, feel free to email us at sales@spartacommodities.com or visit our website. So thanks very much again, and have a fantastic rest of your day.
Thanks, you too.